Hello everyone, I am Dr. Manoj Kumar NV, working as Associate Professor, Department of Management Sciences, Maharaja Institute of Technology, Mysore. So let us today we are discussing about the quantitative and qualitative measures of credit control. The subject title Banking and Financial Services, subject code is 18 MBFM 301. So in the previous session we are discussed about what are all the quantitative measures of credit control, where we are discussed about the bank rate policy, open market transaction and variable reserve ratio, where we are going to get to know what is the relevance and importance we are given for banker rate policies and cash reserve ratio, statutory liquidity ratio, and how the open market operation which is taken place and how it will be used as a strategic technique by the RBI towards controlling the flow of money in the market. So today we are moving to the qualitative measures of credit control, where the first one is regulations of banking margin requirement. So margin requirement, as the name indicates, the changes in margin requirements are designed to influence the flow of credit against specific commodities. The commercial banks generally advance loans to their customers against some security or securities offered by the borrowers and acceptable to banks. So therefore, any margin requirements are designed to influence the flow, either it may be inflow or outflow of credit against specific commodities. So here we use the term as commodities, where the commercial banks, they are ready to provide the advance loans to their customers against some security or securities, and it is accepted by the banks. And when we consider more generally, the commercial banks do not lend up to the full amount of the security. As we know that when we do pledge of our fixed assets or our any securities or any bonds or any agreement to the banker, obviously they are not going to consider the 100% value towards given a loan. Lending a loan, might probably they are going to fix around 50%, 60%, 70%. It depends on the individual banks and their rules and regulations. So in that rules and regulation, they are going to finalize that what proportionate of the loan they are going to be sanctioned when they pledge those kind of the securitized or mortgage assets. So therefore, in a general concept, the mainly commercial banks do not lend up to the full amount or full extent to the particular security, but lend an amount less than its value. So obviously, whenever they fulfill the procedures, the commercial banks are ready to finance them through loans. The margin requirement against specific securities are determined by the central bank. So as you know, we have a RBI as a major bank, major central bank, and authorized and directive measures are given, regulating measures are given by the particular bank. So therefore, whatever the securities are considered in the commercial banks, those securities are going to be evaluated and the margin is going to be fixed by the RBI. A change in the margin requirements will influence the flow of credit. So means when they allowed the particular asset considered for 80%, then the flow of money is more. So therefore, the customers are getting more high amount of loan, whatever the pledge they made on the fixed asset or securities, they are getting a more flow of funds. So like the same way, whenever the government are restrict, whenever the RBI is mandated towards fixing only 50% margin, obviously it is going to be have a control on the bank's credit facilities. So therefore, here it will be influence on whatever the margin requirement that is decided by the RBI, that is going to be influence on flow of credit by the commercial banks. Also, we can consider a rise in the margin requirement results in contraction in the borrowing value of the security. So, borrowing value of the security become more from the point of customer, as well as the bankers are getting more interest, and but with respect to the market value of the particular asset, it may goes up or down. It is going to be controlled. The situations are uncertainty by the commercial banks, and similarly a fall in the margin requirement results in expansion in the borrowing value of the asset. So therefore, whenever there is a less margin requirement in expansion, then the borrowing value will be very lower. So therefore, whenever they do think about fixation of the margin requirement for the particular securities or security, the RBI must need to be taken the right measure towards deciding what will be the margin requirement which is required to consider for the different assets or securities. Then coming to the second qualitative measure is credit rationing. So credit rationing, it is a measure, it is also one of the measure where they are going to seek the limit of maximum amount of loans and advances. So means as a banker, they must need to be shown the proper deposits to issue the loans. Unless they don't have a much deposits, they couldn't able to give it as loan. So therefore, whenever they do providing a loans to the public, they must need to be have a proper deposit. There should be a proper ceiling limit. So all bankers should not be eligible to give 100% loan. They are specified with respect to whatever the deposit they are received, and based on that they are going to be issued the proportionate, not 100%. It should be less than 80%. The proportionate of the particular deposit, they try to push it as a loans to the public, because unless or until the banks are focusing on providing the credit facilities, they couldn't able to meet the rate which they are prescribed for the depositors. So therefore, whatever they do gain from the by providing a loans, out of which the lesser the rate, they are going to pay interest for the depositor. So therefore, the credit rationing is a method by which the central bank seeks to limit the maximum amount of loans and advances, and also in certain cases fixes the ceiling for specific categories of loans and advances. So like if we take an example of financial institutions or any cooperative banks and all, then they must need to be a chance of given a certain cases where they are going to fix the ceiling amount to give a loans and advance. So it is only applicable for in the special cases whatever we discuss. Then in the next point is where the measure which is concentrate on consumer credit, regulations of consumer credit. So regulations of consumer credit is designed to check the flow of credit for consumer durable goods. So means whatever we do business, then based on the transaction, we can able to take the loans. So therefore, that is also one of the consideration to provide a loans to the consumers. So therefore, where they are going to design to check the flow of credit for the consumer durable goods. This can be done by regulating the total volume of credit that may be extended for purchasing the specific durable goods, or regulating the number of installments through which such loan can be spread. central banks uses this method to restrict or to liberalize loan condition accordingly to stabilize the economy. So this is most important thing where we can access more credit card, debit card, smart cards to purchase the products. And the manufacturer, they do provide the installment service even. So because of that, they are going to make use of whatever the required amount, they make use of the short term loans they used to take, or they are going to make a smart payment. So that will be helpful, and there will be a limit even for making a payment in the such a manner where they are going to be consider the consumer credit. So therefore the banker, whatever the transaction charges, they are going to be getting as a spread. So these spreads are always beneficial to the banks because the operational effectiveness will be there, as well as there is no human involvement in the transaction. So therefore it will be reduce the operational cost. Also the banking services here, where they are mainly focusing to how it will be impact to the particular community, and the purchase deal and all, they do the direct payment through making use of banking services. So therefore the central banks uses this method to restrict or liberalize loan conditions according to the stabilize the economy. Sometimes when they do more purchase, keep on purchasing the more, obviously the government, they are going to be put the condition that you must need to purchase only this much. Like if you take example of gold, sometimes the government, they put restrictions to purchase the gold on the same date. So and when it is exceed the limit, obviously the transaction will be hold. So like the same, whenever the government, they are considered, the RBI consider to stabilize the economy, they do work on the consumer credit regulations. And moral suasion, where the moral suasion or and credit monitoring arrangement are other methods of credit control, where they mainly focus on this policy for moral suasion will succeed only if the central bank is strong enough to influence the commercial banks. So like we can take an example, we call it as RBI as a banker's bank, because whenever the commercial banks, they are in the difficulties, they are in the trouble, they are in the issues, those are the issues are the financial weakness, and the financial assistance are going to be met by RBI. So therefore moral cessation, that will be helpful to the individual bankers like commercial bankers, where they are getting a monetary arrangement and monitoring work or supervisions are made through credit control. So therefore this is also one of the positive note from the RBI, where it will be helpful to every individual commercial banks with respect to providing the moral support. In India, from 1949 onwards, so in 1949, so Banker Regulation Act, which is established, the RBI has been successfully using the method of moral cessation to bring the commercial banks to fall in a line with its policies regarding to credit. So publicity is another method whereby the Reserve Banks makes direct appeal to the public and publishes the data, which will have sobering effect on other banks and commercial circles. So here we can notice two things. One is the RBI given the direct appeal to the public and published data, where they are going to be given how the performance of the commercial banks, as well as they are providing the moral support to the bankers whenever they do fall in their credit rating, or when they fall in the profitability, they are going to be given a support to those kind of the banks to empower and to regenerate themselves and perform well. So we can take an example where the SBI and its merger in the 2019, where the more than 5 subsidiary of SBI has consolidated together to make the SBI into one of the 200 listed world 200 listed position. So that is going to be shown how to maximize the size and how to concentrate consolidation has to be taken place in the particular era, where whatever the banks except SBI and SBM, the rest of the SBI subsidiary are in the loss or in the financial struggle. So those banks are combined together. So therefore, the firm value, the asset of the SBI become larger in the size and in the value. So therefore, they are sticking to the global position. So therefore, whenever the banks are dominating, when they are weakening in the performance, those are going to be ascertained by the RBI, and they are going to give a moral support, as well as they are going to be given the particular published data where they are going to stand for with the position and ranking. So that is going to be given more importance to the particular bank. So therefore, it will be set as a rank standard that will make that every individual to work on the banking services and banking performance. Then effectiveness of credit control measures. So credit control, as we said, it is the most important point where every banks must need to be focused to given a credit facilities. It is going to be directed by RBI, and also it is depends on the individual performance and individual consideration. Everybody, there is a restrictions to follow the RBI rules. Still, it is going to be depends on the individual system of the banks. The effectiveness of credit control measures in an economy depends upon the number of factors. The first factor which we are going to discuss today is there should exist a well organized money market. As we know, money market, it is a short term market. So when we consider the commercial bill, commercial paper, bill discounting, bills of exchange, treasury bills, so these sort of the money control instruments which are traded or which are going to buy or sell in the money market. And the second one, a large proportion of the money is circulation should part of the organized money market. So organized money market, which will be give you a large proportion of the money like treasury bills and all. When we consider only the organized money market, where well organized money market, where it is going to be provide the sum of money, but when we consider the large proportion of the money, then it will be organized money market. Finally, we have two types of the market here: capital market and money market. Capital market, which is focused on long and large amount of money proportion, where we are consider the money market, it is a short term, and it will be work on less amount of proportionate of money. So finally, the money and capital market should be extensive in coverage and elastic in nature. So coverage, so when we consider the coverage, the entire coverage, majority of the money flow which is rise through mainly from capital market, also from money market, but when we considering the nature, it is more elastic. So more elastic in the sense, how much you are increasing the flow of money, that much you have a risk, and the credit control parameters will be higher. So therefore, they are going to plan how much to rise in capital market, how much to rise in money market. So this is the combination where everybody they are going to be planning towards how to raise the funds, what are all the different modes they are going to be used to raise the funds. So therefore, it should be very careful note where every individual firm they must need to be concentrate to raise their funds either in capital market or in money market. When they use the capital market, surely the capital market enlarges the value of capital requirement. But when we consider the short-term money, whenever we need the immediate cash, the liquidity enhancement, at that time we can go ahead with money market instruments. So therefore, when we seek the effectiveness of credit control measures, where we are going to use the major two tools or two market which we are going to be used. One is organized money market, as well as the second one is organized capital market. So these two markets are controlled by RBI and as well as SEBI. So therefore, there should be a rules and regulation, fixed rules and regulation must need to be fulfilled by the individual. And coming to extensiveness enlarges the scope of credit control measures and elasticity lends adjustability. So extensiveness means whenever we think about enlarges the scope of credit control measures, then we are going to be say that it is extensiveness, and also it is focusing on elasticity lengths to adjustability to the changed conditions, like the market immediately react negatively to the capital market, then we need to look into the money market. In the vice versa, we need to be properly planned based on the market condition, because it is completely depends on the market scenario. So in most of the developed economies, a favorable environment in terms of the factors discussed before exists in the developing economies. On the contrary, the economic conditions are such as to limit the effectiveness of credit control measures. So means as we heard in the 2009 Lehman Brothers in USA, they are providing a house loans without getting any guarantee or security from the customers, or the person the applied for loan, they just provide the loans without considering any guarantee and surety. So afterwards what happened, they find very difficulty for recover whatever the amount they are issued. So later the part they are fall under bankruptcy and the completely bank operation is closed. So that is the impact in the global market, where it is dropped down. The entire market crash which is happened in 2009 due to that. So, but it is not much impact to Indian market, because only the reason is whatever we have measures, regulations of RBI and restrictions and whatever the terms and conditions are of RBI, that is not allowed the our banking system to face the same type of condition, because of we are prepared and we are established and we are regulated and we are monitored and supervised by the central bank, that is RBI, where they have taken the very right decisions towards what are all the sort of measures which we are need to be considered to credit control. So therefore, whenever we are consider most developed countries in the favorable environment, and those factors also need to be taken into consideration towards developing economies, where as our country, where they also must need to be considered the economic conditions such as the effectiveness of credit control measures. So therefore, it shows how the country is working with respect to whatever are the measures they use, how it is going to be impact to them, whether it is feasible for them and if they are practicing the same, if they are practicing, how effectively they are practicing, These are the major thing where they are going to be concentrating in consumer credit and direct action. So even the RBI, when we take in the RBI, they always have a bird eye view in all the qualitative as well as quantitative measures. These are the measures are most important in the context of how we can able to make the more flexibility and feasible credit control system to the country. So in this point of view, where we are concentrating on the major measures like qualitative as well as quantitative. So here we are mainly focusing on 6 key points. So 3 for quantitative and another 3 for qualitative measures. So once again I will repeat it in the very specific way, where in a banking and financial services, where the RBI plays a major role as a central bank, where they have a credit control system. For that credit control system is managed and it is controlled by through the measures of qualitative and quantitative aspects. So in the quantitative aspects, where we have a banker rate policy, open market operations and variable reserve ratio. So as namely it is a banker rate policy, means whenever the commercial banks they go for discounting the bills or bills of exchange, or whenever they do borrow the money from the central banks, they need to use bank rate policy. So where when the bank rate is high, then there will be impact on all interest rate. When the bank rate is low, it is impact on all the interest rates. So when it is high, all interest also will be high. When it is low, all remaining interest rate also become lower. So therefore they should be very carefully need to careful steps which are required with respect to bank rate policy. Then open market operations, where in the open market operation they are going to be use the money flow. When the money flow is high and when the money flow is low, they are balancing the economy with respect to inflow and outflow. Whenever they found that there is a huge money flow in the market, then they are going to be issue the government securities and they get the whatever the excess cash which is transacted in the particular market as same. So therefore they are getting equal monitoring system, where everybody they are going to be have a same cash level. When it is low, when the market itself have a low money transaction, at that time they are going to sell the government securities. The advantage of those government securities, when they issued the government securities to the commercial banks for the purpose of avoiding more excess cash flows, they are going to be issued at discount, and whenever they are buying from the commercial banks, then they are going to be given premium. So therefore when they issue that, they are given discount, and when they are when they are buy it, at that time they are going to be buy at premium. So therefore commercial bankers, whatever they do have reserves, those reserves, excess reserves than whatever the limit, those reserves are going to be invested. Excess liquidity is going to be invested on the particular government bond. So therefore that is also will be helpful to the commercial banks. Instead of keeping the particular reserves as a dead cash, they are going to be get the returns for whatever the investment they made on open market operations. Then the variable reserve ratio, where we are mainly concentrating on two types of reserve. One is cash reserve ratio and another one is statutory liquidity ratio. So cash reserve ratio, the name only indicates the bank should need to be keep 3% of whatever the deposit they are collected. Out of that 3% of the reserves, they must need to be keep it in the RBI. So that we call it as our cash reserve ratio. So therefore whenever the cash reserve ratio is high, the amount of loan issued become lower. So therefore, properly need to be managed the particular cash or liquidity in the bankers. And the second one is statutory liquidity ratio. It is the liquidity which is maintained by the individual banker. Instead of giving to the RBI, they keep themselves as a liquidity. So that will be around 18% at present, where every banker, they must need to be keep the reserves of 18% as a SLR. That is, make sure that the bankers have a ability to give right credit facilities at the right time. So therefore, always the banker should have a proper liquidity condition, then only can able to manage and serve the purpose. Then coming to the qualitative measures, in the qualitative measures where we are concentrating on regulation of margin requirement. So in the regulation of margin requirement, where they are going to discuss how much margin they must need to be give it as a credit to the customers. So therefore, they are going to fix what will be the margin should be maintained by the banker, whether the standard margin which will be prescribed by the RBI, and they must need to be followed at the same, or else they are going to fix more than that. Then credit rationing. So the credit rationing, which will be considering how they are going to be planned with respect to the commercial bank seeks their limit to maximum loan amount and advances. So where here also for individual, how the banker must need to be focused on providing loans and advances, because here whatever they received as a deposit, entire amount they are going to be not issued as a loan. So therefore, there are also some conditions and ceiling limits are there with respect to providing the amount of loans and advances. Then the last one, where it is concentrating on consumer credit. So for consumer credit, so everybody, you may heard the CIBIL score. Based on the CIBIL score, they are going to be get to know the credibility or credit worthiness of the individual. Based on that, they are going to decide whether to give a loan or not, or whether how much loan can be sanctioned to them. So therefore, these are the measures which is always helpful to the individual bankers to decide the person, or as an individual or as a business, they are going to get to know what their status and the worthiness of the company. Based on that, they can able to provide the banking and financial services. And here we mainly focusing on the mode of credit, where whenever they go for any purchases, like any durable products purchases, they do purchase by using the credit cards, by using the smart cards and all, and how those cards will be helpful for them to know whether the installment or whatever the installment they are going to precise or calculated, those installments need to be met by the individual. It is decided based on the whatever the income is shown or whatever the property he has. Based on that, the banker need to be decide that what amount of credit facilities need to be provided for the individual. So therefore, whenever the central bank uses this method to restrict or liberalize the loan conditions according to stabilize the economy. Sometimes if they use credit cards for the 6 months, once they purchase it, immediate month they have to, at the end of the particular month, they must need to be deposit the cash for whatever the amount they claim. So like the same, whenever they go for the installment, sometimes those installments are providing with the 0% of interest. So that is going to be helpful for the consumer to buy the product without incurring any interest. But so therefore, it is going to be increase the economic stability where the cash flow is more. In the same, sometimes they put the restrictions, like if they use more than the beyond the limit, they are going to be charged very high interest. So therefore, the consumers are afraid, or they are very not much satisfied to make use of the particular cards a number of times. So therefore, whenever the government decide, the RBI, they are going to state the policies with respect to what are all the liberalized or restricted conditions to stabilize the overall economy. So therefore, you can easily notice where how these commercial banks are going to be benefited by providing. Nowadays we can see banks all banks, they are going to be provide the credit cards. Even though we are not interested, they are going to keep on calling and keep on pressurizing us to buy or to get the credit card facilities, because the bankers, they are supporting the economic system to make use of more liquidity or more cash flows in the market, rather than we just make use of the hard cash in the transaction. So all these things, along with this, there is always the supervision and the guidelines and regulations are prescribed by the RBI, and moral support which will be given by the RBI for all the commercial banks to set proper target and to control the entire credit system. So therefore, sometimes it may liberal, sometimes it is more mandate to have a policy and procedure to fulfill in under qualitative and quantitative measures. So the Reserve Bank of India has been successful. It is very successful in using the method where they are cessation to bring the commercial banks to line up with the policies regarding to credit. So therefore, the unique policy which is always helpful to the individual bankers to follow up, and to whatever the framework they are made, within that framework every banks are going to be decide the margin. So you may visit any private banks where they are put their interest rate chart, where the interest rate charts are comparatively it is almost same, but only we have a small fractionate difference from one bank to another. So therefore, those base rates are prescribed by RBI, and the remaining whatever the variations except base rate, whatever the variations they have with respect to 10.5, 10.15, 10.25, so the fractionate which will be decided by the individual commercial banks. So therefore, India as a developing country, we have a very regulated, very formulated credit facility and credit control which is directed and regulated by RBI. So therefore, we are not have a chance where, like whatever the other countries they are have a financial instability, we are not face the same thing as other countries. So therefore, each and every banker in India as a commercial banker, they must need to be known all the whatever the measures which we are going to be used to have a better credit control system, where they are going to be used the quantitative as well as qualitative measures, which is always leads the as a developing bank, as a developing country, surely they have a very good exposure in the global market. And even whatever the Indian financial system we have, it is almost few of the countries are followed us with respect to whatever the policies we had, like a fixed policy or monetary policy, and as a central bank, whatever the policy and procedure which we are going to be followed, those policies also inculcate by the other countries. So therefore, it is one of the more appreciation given to the entire Indian financial system, where they are formulated the structure, like where each and everybody they are going to be following in the particular framework, and they are going to be work on hand on hand. So therefore that is going to be helpful to known and to aware and to understanding about how the banking system is going to be performed, why do we have different rate of interest, and why the India has a very dominant credit control system. These are the things which we are going to be discussed in this class, and hope you are understand why these qualitative and quantitative measures and how it is going to be incorporated in the banking practices, and how it is going to be helpful to the individual bankers towards go for expansion or towards go for new banking facilities, how and what are all the things they must need to be considered prior to the incorporation of banks. So therefore, as per 1949 Banking Regulation Act, they clearly prescribe that how the bankers must need to be performed and what are all the things where they must need to be noticed where they are going to go for credit facilities. And whatever the deposit system we have, whatever the deposit they do as individual, those deposits only on their returns based on how we are effectively implement the credit control system in the particular bank. So therefore every bankers are responsible, and they must need to be concentrate on all the practices of credit control, that is always makes the banker into more effective and more efficiency with respect to the liquidity condition as well as banker spread. The profit of the bank will be higher, and there is always will be a financial support and the financial assistance by the RBI, that is always makes the individual banker into more profitability, and whatever the target they set, easily they can reach the target without having any inconvenience and uncertainty. Uncertainty will be there, but the proportionate of the uncertainty become lower when they are considered and make use of the practices of credit control system. So therefore with this today class we are learned how the qualitative and quantitative measures are most important, and how it is going to be helpful to the banker. So therefore your understanding should be needed with respect to all these aspects. So thank you for listening. Thank you one and all.